So thank you for coming out in the weather, and I will be talking today about the Sveriges Bank, Riksbank prize in to honor of Alfred Nobel, and this was given to 3 scholars. I'm just to introduce myself, I'm Dave Cook. I'm a professor at the Department of Economics at HKUST SBM, and I will be talking today about a prize given in 2022 to 3 scholars on who are noted for their research on banking and financial crises. And just to say a few words about these scholars, these are, I guess, in alphabetical order. Ben Bernanke, who is at the Brookings Institution, which is a policy-oriented think tank, maybe the policy-oriented think tank in Washington, D.C., but he is probably best known as the chair of the Federal Reserve, the Central Bank of the United States, and prior to that, he had a long association with Princeton University. And the other 2 winners are Douglas W. Diamond, who had a very long association with the University of Chicago, and Philip H. Dybvig, who also has been long associated with Washington University of St. Louis. Okay, so essentially the Nobel Prize Committee commended these authors for various contributions that they've made to the study of banking and financial crises, but they highlighted 3 particular works that are going to be associated with these authors, and so I'm going to be spending my time today to discuss these particular contributions with some reflections on how these contributions ultimately had spillovers to further work by these gentlemen and a few others. This research, these research papers, each one of them kicked off very large literatures that there are many scholars who followed in their footsteps. Many of them, including myself, have cited these works in their subsequent research. And there are thousands of us who have. So I'm not going to spend a lot of time on that further literature, but I would recommend the scientific background paper offered by the Nobel Prize Committee that provides an accessible intro to these literatures. Also, it should be noted that these scholars themselves, as path-breaking as their contributions were themselves building on the work of previous researchers, which I will not delve into as well, because we could be discussing the work of many people. And so we'll try to keep the discussion concentrated on the particular work that is most cited by the Nobel Committee. One of the odd things about this particular prize is that although these 3 authors were working on very similar topics, and of course 2 of them were working together, the approach that was used to the study of banking was quite different amongst the different authors, and in fact were in some sense polar opposites in terms of their contributions to the theory and practice of economics. So first we have Professor Diamond and Professor Dybvig, who were working in quite abstract theory, and so we're developing basically from the ground up a clear statements about the underlying forces that are going to contribute to the markets that we see in credit and liquidity provision, which we refer to as banking. Professor Bernanke was taking a much more applied approach. Of course, he has made many theoretical contributions himself, but the work for which he is going to be noted here in this prize is extremely applied work of a detailed study of the U.S. economy as it progressed during the Great Depression, building a set of evidence for the importance of banking in financial crises and the overall macroeconomy, and was pioneering in this approach, but ultimately did such a good job persuading people of the importance of his viewpoints on banking that he was named to be a key policymaker in the United States, and as it turned out, was the most important policymaker during the biggest financial crises that country and, in fact, the world have seen since the Great Depression of the 1930s. And so we see that this work really does span from the building bricks of economic logic to the most applied policymaking that we see. Okay, and so because of that, a lot of perhaps the guiding light of the unifying principle that we could see lies behind this prize is the role that the thinking of Diamond and Dybvig played in understanding that global financial crises, and also the impact of the evidence that Professor Bernanke brought to himself and his policymaking institution, along with other policymakers, to understand that the proper policy response to this financial crisis. Okay, so as I discussed the various research that these gentlemen did something like 40 years ago on economics as scholars, I'll also try to illustrate their ideas with some of the important elements of this financial crisis that occurred roughly 15 years ago. Hopefully we'll illustrate these. Okay, so first what I want to do is to begin with out of order in terms of alphabetically, but perhaps think of the work of Professors Diamond and Dybvig in developing the economic theory of banking. Okay, so when we introduce markets to new students to this field, we try to illustrate the power of markets to deliver good outcomes by with a description of efficient markets, which we can think of as markets that allow buyers and sellers to realize all the possible gains from trade simply through the easy adjustment of prices. Okay, but this basic description of efficient markets that we see in Economics 101 requires a long list of preconditions for markets to deliver the ideal outcomes that we might see. And that is may be realized in practice in certain cases, but we have an understanding that most markets will not feature all of the necessary preconditions for an easy acquisition of pure economic efficiency. Okay, so what we've done in economic theory since at least the 1970s is working on illustrating the different ways that markets, which lack the important preconditions for efficiency, may fail to achieve efficiency, and also try to illustrate the sorts of market institutions that are likely to arise in the absence of purely efficient markets. Okay, and so what the approach of this type of theory is to think about the fundamentals of market failures, think about the types of institutions that we might see that will help us to achieve efficiency, and then also think about the types of public policy that might help the market institutions to further edge toward the ideal benchmark of realizing all potential gains from trade. Okay, so what the theoretical work of Professors Diamond and Dybvig does is follow in this approach of formalizing market failures, and they do so on thinking about the basic institutions of banking. Okay, and so first what I'd like to do is talk about the initial paper in 1984 by Professor Diamond, and his work focuses on the theory of credit. So credit we can think of as the issuing of loans to borrowers who might want to use funds for private purposes. Okay, and this credit theory will, in Professor Diamond's view, give rise to institutions that look like what we think of as banks. The companies that we see are responsible for a lot of lending in the economy. Okay, and so what we do is try to identify a basic source of market failure that leads to the institutions that we see, and maybe if we're going to be focusing on finance, the basic element, the basic challenge that is going to be faced by finance is going to revolve around information. The economics of information. And there's going to be one reason that we see for that, which is that most finance, most providing of investment for real projects that might lead to economic development are going to occur across time. And so their investment today to finance better outcomes for the future. But the future is likely to be uncertain. And so this creates a lack of information, which creates its own particular challenge. Now, the risk of good versus bad outcomes in the future, this uncertainty about the future, we normally call risk. And risk is going to be a challenge for financial markets, but financial markets have developed tools to manage risk, which mostly revolve around the concept of diversification. That is, to spread the exposure to uncertain outcomes as widely as possible, and to have individuals have limited exposure to particular sources of risk. And in a perfect market, we should see a lot of diversification. But that may not be enough because of another information problem, which is very common in financial markets, which is the problem of asymmetric information. So there are going to be transactions in financial markets and other markets in which the various market players are going to have uneven information about the transaction. And that raises a challenge of cooperating with somebody on a in a market when they may know something that you don't know. So there's going to be a fundamental imbalance there that we might see that will lead to a lack of full efficiency in markets. Okay, and so there's going to be a particular source of uncertainty in markets for investment because people who seek investment to finance some sort of project for building some company or for the future are going to be likely to be managing that company, and they're likely to have an information advantage over their particular external sources of finance. Okay, and so we hear a lot about venture capital in the tech industry, but that is actually an exceptional outcome. That we see in most cases when we see businesses that are in the phase of building from a small enterprise toward a larger scale. We're going to see that mostly those businesses receive financing through the channel of borrowing, through the channel of debt. So this is a question: is why do we have so much of this type of finance of new firms who are in the stage of development borrowing money rather than raising funds through equity partnerships with their investors? And asymmetric information is the answer. That is to say that except in exceptional cases, that you can't really be a silent partner in a business that it has inside information, because the owners of that business have an incentive to divert any upside, any positive outcomes toward themselves, to use the good, if they have a particularly profitable business, they have an incentive to use those payoffs for themselves rather than share them with their silent partners. Okay, and so in such a situation, then debt will play a role, because it offers a disciplinary device to say that you have an obligation to pay a certain amount of money, regardless of how good or bad your outcome is, and you will be expected to repay your debt, and you will be punished if you don't repay your debt by losing your business. So your creditors will be allowed to take everything. The problem with debt as a form of finance is that it's extremely unforgiving. So if you do have a bad outcome, then you are going to be punished, even though you experienced some business failure that was no fault of your own. And so as a result, we're going to see many cases where businesses will be liquidated, when maybe a better outcome would be for the investors to share some of that unfortunate downside rather than force a closure of the business. Okay, and then what that means is that there will be too many liquidation loss, too many bankruptcies if businesses that must declare bankruptcy, and there will be then because of those liquidation costs, lenders will naturally charge high interest rates, and there will be a inefficiently low number of businesses that can receive debt finance. Okay, and so what Diamond says is that, well, there's a better outcome, which is to have lenders who aren't silent partners. Rather, these lenders can actively participate in a business that is being financed through lending, and that finance can involve a screening of borrowers before loans are made, a series of restrictions on behavior by borrowers, and also an active monitoring of the business activities of borrowers to increase the information that is going to be available to lenders. And by acting as active partners, then these lenders can reduce the chance of diversion of funds, and thus they can offer lower interest rates to their borrowers, and then can finance more businesses, leading to stronger economic development. So this was the idea, is that this is what we see when we look at banks, is that they're not just handing out money and demanding people repay at some future date, but they are active partners, placing restrictions on borrowers' activities, and in fact acting as what Diamond call monitors. Okay, so this idea, which is, I think, quite natural, what we see in terms of the banking, is going to lead by itself to a lot of different consequences that we're going to see for our monitoring lenders. Okay, so these lenders who monitor their such businesses are going to, over time, develop as storehouses of information. That is, they're going to build an inventory of knowledge about their borrowers that will give them an advantage to lending to those borrowers in the future, or lending in similar businesses. Therefore, part of the assets of such a bank are going to not only include the book value of the loans, but their relationships with their borrowers, as well as the information that they've developed over time. So these businesses have value as enterprises beyond simply the loan book. Another implication of this structure of the banking industry is that bank assets are likely to be not very liquid. That is, the part of the assets of the banks are going to be their specialized information. That's going to be that is itself value that might be difficult to sell. But they're going to have made a lot of loans based on their special inside information about the businesses of their borrowers. So if the banks want to sell those loans to other people in the financial marketplace, those loans are not going to be as attractive to potential buyers, because those buyers won't have information about which loans are good and which loans are bad. So it's so in some sense, the banks that operate this way, by developing this information, monitoring their borrowers, are going to inherently be holding illiquid assets. Okay, the key point of Diamond's work, however, is that there's still going to be an information issue. There's still going to be an information balance here, which is to say that that information costs are likely to be fixed costs. That is, you don't want to have many people doing the same monitoring, because if one person develops information about a borrower, then it's going to be most efficient for other people not to repeat the same process, not to double the same efforts. So this, what Diamond says is that the most efficient outcome is going to be what he calls delegated monitors. That is, there's going to be specific institutions that will take on the role of monitoring borrowers and act as an agent for a pool of investors who would like them to do the monitoring themselves without doing extra inefficient effort. So the most efficient way that this could work is that there's going to be one agent in charge of monitoring each loan, but that loan might be financed by a pool of investors who are counting on the bank to do that monitoring. But then the bank has information that the pool doesn't have. So then how do the investors in the monitor make sure that their interests are going to be represented? Well, they do that by financing these monitors through debt to demand that the monitors who get financing from the pool of investment repay in order to fixed amounts of money, regardless of the outcomes that we see of the loans that they make. So debt reenters here as a disciplinary device, one step removed, because the pool of investors are likely to demand fixed levels of repayment from the banking institutions. And this is what we see with banks. That is, they finance themselves with debt and pools of debt from relatively small investors. That debt we call bank deposits. That is, the bank is obliged to pay their depositors a fixed amount of funds. And that demands of their depositors for funds acts as a disciplinary device on the banks. So what we see is that we have our financial intermediation that we see in the real world of small depositors deposit money at the bank. Banks have fixed repayment obligations, and then the banks will act on the behalf of the depositors to ensure that the money is repaid as best as possible. Okay, and so what we see is that this simple idea of banks acting as monitors to overcome this asymmetric information gives rise to the institutions of banks that we see. And in subsequent work, Professor Diamond and a colleague developed the idea that the particular structure of deposits that we see are also likely to generate the greatest level of efficiency. Okay, so essentially, the outcome here, however, is not perfect, which is that lenders are going to then absorb the risk that the borrowers, the ultimate borrowers, are not going to be able to repay their debts. They absorb a default risk. Okay, so bank lending is still risky, but now the risk is going to be concentrated to these two banks because they have obligations to their depositors, whether or not the ultimate borrowers repay their debts or not. Okay, so that means that banks then will try to mitigate their risks, and they do this by trying to diversify the loans that they make. They're going to lend to multiple borrowers and try to avoid the exposure of risk to any given borrower. So we see this institution where there will be a bunch of small investors depositing their funds to banks, which will act as monitors for a diversified set of loans. And if the banks can diversify their lending perfectly, then we can eliminate default risk. However, that can't happen in the real world because there is going to be one factor that is going to prevent banks from being able to perfectly diversify their lending. And that's going to be aggregate, market-wide macroeconomic fluctuations. So there are going to be economic downturns that will occur throughout the entire economy, and that's going to affect all the borrowers and on the bank's lending book, and they will then face the risk of there being a system-wide defaults on bank loans, which will then put the banks themselves at risk of not being able to meet their obligations to their depositors. Okay, and so the main risk that we see for banks is going to come from macro level risks, the risks that come from the macroeconomy. And the second thing that we say is that banks do have a tool that can protect themselves from macroeconomic risk, which is they can partially fund themselves through equity. That is, banks are going to not only get financing from depositors, but they're going to sell shares, and their shareholders can share some of the downside risks of a negative macroeconomic outcome. But because of the information advantages of banks are then going to may have difficulty raising trust amongst the shareholders that the banks are going to share the upside outcomes of high profit periods with the shareholders, although the shareholders they know are going to definitely share the downside risk. So for that reason, the reason that banks themselves might divert some of the upside of good times to themselves is going to make bank equity particularly costly to issue. That is, shareholders are only going to own these shares at a discount because of the exposure of the shareholders to downside risk without necessarily all of the upside. So banks are going to get partners in by issuing shares to cushion themselves as a risk. They're going to finance themselves with capital rather than deposits. But they're going to be reluctant to do so because that type of financing is likely to be costly. Okay, so what we see is that this gives us a structure of the banking system. And what we're going to see as a kind of decision that is being made by these institutions in order to generate the greatest amount of profits for themselves. And this type of structure that we see of banks issuing small deposits, financing to a certain extent with equity capital, but exposing themselves to macro level default risk is going to be an efficient structure. That is, given the constraints of the economy, this is likely to be the most competitive way that this type of finance can be structured. So we're likely to see our finance industry, at least certain components with asymmetric information, going to be dominated by institutions that have this particular structure. Okay, so and as an illustration of that we see is that we have our traditional banking sector. This is going to be heavily regulated, but what we see is that in new parts of the economy, what we see is that there are another set of institutions that arrive that don't necessarily call themselves banks, but will act as if they are following this diamond-style structure. That is, they will finance themselves by borrowing from a big pool of borrowers, offering their creditors a ready access to the funds whenever they want to have them, and using them to financing themselves with short-term debt, and using that investments from these small investors to invest in relatively illiquid assets. And so this type of activity that we see replicates the structure of banking and became an important part of the finance system. This is data from global data, but maybe was especially important in the United States in the years leading up to the global financial crisis that we saw in 2008. And we call these sort of parallel banks that have a diamond-style structure without necessarily calling themselves banks. The term that is frequently used for these types of institutions are going to be shadow banks. And what we see is that over time there was a rapid rise in the size of these non-bank finance sector. This is from the Global Shadow Banking Monitor, up until the financial crisis of 2008. Okay, so maybe the most interesting part of that shadow banking followed a particular structure that was very interesting during the global financial crisis, which is that you had a lot of mortgage loans, which are going to be loans that are used primarily to build housing. And those loans are going to be essentially owned by what were called special financing vehicles, which were going to be what we think of as shadow banks, that they're going to be set up to own the proceeds of these relatively long-term illiquid loans, and they would finance themselves by issuing what's called commercial paper, which is very short-term debt. Okay, and so this short-term debt was held by another set of institutions, which were called money market funds. Prime money market funds specialized in owning this commercial paper called asset-backed commercial paper, which is going to be their investment. And then we have a variety of small retail investors who are going to have accounts at these money market funds. So what we see is that this structure of this financing scheme did match that which was specified in Professor Diamond's theory in terms of owning illiquid assets and financing them with short-term debt and relatively little capital for the ultimate benefit of small-scale retail investors. So our diamond-style delegated monitors as a structure are going to be replicated by these institutions, even if they are not going to be themselves acting as banks. Banks have another role in the economy, which is that they provide liquidity to their investors. Okay, so there's going to be one more aspect of banks, that the theory that is going to be developed jointly by Professor Diamond and Professor Dybvig features, which is a solution that we see to a fundamental problem that we see in market capitalist economies, which is capitalist economies based on investment are going to require long-term investments in specialized production, the specialized means of production, which will be undertaken through capital projects that will be used for long-term operations. So all the factories that we have, all the buildings that we have, all the equipment that we have that we use to produce goods, these are going to be very long-term assets that are quite specialized and thus are not going to be easy to sell once they've been put in place for production. But the consumers in our market economy require liquid assets to buy goods. We require money. Okay, and so then we have a mismatch in terms of the assets that the production side of the economy needs and assets that the expenditure side of the economy needs. And so financial institutions are going to arise to fill in that gap. And so this is a theory that's going to be developed by Professors Diamond and Dybvig in their work, which is that how do you, with an economy in which the underlying source of wealth is long-term capital, how do you develop short-term or liquid assets that can be usable in transactions? So the idea here is that we might ask is that how do we back bills, how do we back dollar bills with buildings? Okay, so essentially what Diamond and Dybvig argue is that the liquidity needs of our household sector or of our purchasers of goods or our financial assets, the liquidity needs of ordinary individuals is essentially a insurance problem. So by insurance problem, we mean that you have, that we see that people have liquidity needs. They need to have money for purchasing goods, but their liquidity needs are going to be unpredictable at the level of the individual. That is, you don't know when you're going to need money, but they're going to be quite predictable at the broader level of the household sector, which is to say, we know that a certain fraction of people are going to need to have liquidity to engage in unpredictable purchases, and that might be a business opportunity, or it you may find something that you really want to buy, or you may have some health problems or other unexpected event that might cause you to want to spend a lot of money. Okay, so there are two ways of solving that problem, is that each individual can keep an inventory of liquidity in their, that is available to them just in case they need it. But that would be inefficient, because if we hold our wealth in the form of short-term investments, then we'll have a shortfall in our financing of the long-term investments, which are the key element of our economic production. Okay, so then we can then solve this with insurance. That is, individuals, rather than keep their own inventory of liquidity, can pool their liquidity together and then make payouts of liquidity to meet people's needs when they need it. And since only a small fraction of people may actually need to have liquidity in any given period, we can keep the wealth of this pool of investors in ultimately in long-term investments, which are going to be the most productive and offer the highest returns. Now, it's difficult to structure that as traditional insurance, like health insurance. That is, since it's difficult to identify when people actually do have liquidity needs to give them payouts, we see that there may be a better alternative structure. And the alternative structure that seems to arise is demand deposits, deposits at the bank. That is, what we see is that people put their funds in the bank in deposit accounts that allow them to withdraw at any time. The banks will use those funds to invest in long-term or illiquid assets. and allow their depositors to take their money out at any time that they have liquidity needs, paying a penalty that you'll lose out on the returns, that the interest that you could have earned on your bank deposits. And therefore, if you do need liquidity, you'll pull your money out. But if you don't need liquidity, then you have no incentive to do so. And so what we could see is that this type of structure of banks that offer deposits on demand keep a fraction of those deposits in the form of liquid assets and use the vast majority of those funds to invest in long-term illiquid loans that offer high returns will be the dominant structure that we see for financing that's coming from individual savers. Okay, and so this demand deposits with what we call fractional reserves, that is lending most of the money, keeping just enough to meet those liquidity needs of the depositors, is going to be an efficient solution to our problem of how we back bills with bonds. Okay, and so what we see is depositors will provide funds to bank. Depositors can claim back their funds at any time. Most are going to be, the banks will have an incentive to keep just enough funds to service their depositors, and they will meet their needs as such. Okay, so and so what we see is that these types of demand deposits are going to be an efficient mode of financing our investment and providing liquidity to meet liquidity needs. But they're also going to have a problem, which is that we could also see that there's going to be another possible outcome in a institution that is structured in this way. And that is to say that we could see another outcome, which is that there are, because of the strategic considerations of the individual depositors who know that there's only just enough liquidity to meet the demands of a certain fraction of the bank's depositors, who realize that if the demands of the depositors for funds exceed those limited amounts, then the banks will need to liquidate some of their long-term assets. And if the liquidity costs of getting rid of their assets are sufficiently large, then ultimately the bank may not have enough funds to meet their potential obligations to all of their depositors at once. So this system relies on not everybody pulling out their money at once. But if people do pull out their money, then they will have any individual will have an incentive to get their money out first before the crowd tries to take away that money. And that type of outcome, Professor Diamond and Divvig say, is going to be the prototypical bank run, which is that we see that we can have banks who are set up efficiently as liquidity providers could melt away if all of their depositors decide to take out their funds at once. Okay, and so these things are going to be possible. Now, and so is that possible in banks in the real world? That's what the theory says. And what we can say is that one thing that people who live in Hong Kong know is that yes, this most definitely can happen. So this is an event that occurred in 2008, something that I witnessed myself going to a shopping mall. I was going to dinner and I saw that there was a line stretched around the shopping mall. And usually in Hong Kong, Kong, when there's a line, you walk to the front, you'll find a popular new restaurant that is drawing a big crowd. But so I followed this line up to the front, and at the front was not a popular restaurant. It was the Bank of East Asia. And people weren't there to get sushi. What they were there to do is get their money. And they were getting their money because they heard that everybody else was getting their money out of this bank. And if people took their money out before them, then this bank, which is one of the oldest independent banking institutions in Hong Kong at the time, was going to go bankrupt. Okay, so this is something that we observe in practice with and I've seen with my own eyes, so I know that it's true. And so what we see is that once again what we see is that we have a description of an efficient banking system which lacks resilience. That is, the outcome that we are likely to see that delivers the greatest efficiency, that has the lowest cost of finance and delivers the greatest services, is also one that is likely to be extremely fragile. That is, it can disappear when faced with adversity, or according to Diamond and David, can disappear for no reason at all. And this is one thing that we saw in the shadow banking of 2008, the shadow banking system, is that in September 2008, at the very time people in Hong Kong were trying to get their money from the Bank of East Asia, a wide variety of money market investors were trying to extract their money from the shadow banking system all at once. And this is some economic data to show how big and how fast money was being pulled out of the shadow banking system that we saw in the United States at this time. Okay, so that was no coincidence that we, according to the original theory of this paper, that we can see banks melt away for no reason at all. But we're, in practice, more likely to see these types of bank runs occur when the banking system faces adversity. That is, when banks do have some potentiality of not being able to repay all their depositors in the first place, that's when bank runs are most likely to happen. And when is that going to occur? It's going to occur in macroeconomic downturns. Remember, banks are, the risk that they face, the prime risk that they face is going to be macroeconomic risk. Okay, so when there's a severe enough economic downturn, then banks will be pushed into that zone when their depositors will have their doubts. And banks are likely to collapse, but the nature of banking collapses are going to have the characteristic of being panics. That is, people will all of a sudden try to get their money out as quickly as possible. There are some reasons that for banks to have bank runs more likely to occur in economic downturns. There's a formal theory of that. I won't get into that. Okay, now our third point. Now we get into the macroeconomic risk. So in the 1970s, there had been many debates about the origin of the previous worst, and I guess still all-time champion economic downturn, which is the Great Depression of the 1930s, also centered in the United States. And there were two big theoretical arguments about the nature of that downturn between, on one camp, the Keynesian side, which featured a argument that a sense of pessimism just caused people to stop buying goods. Another theorist named Milton Friedman, who headed a camp called the monetarists, thought that the main source of downturn was people didn't have liquidity that they needed to buy goods. Okay, and that's where the empirical work of Ben Bernanke came in. And so what Professor Bernanke did was he looked very carefully at the historical data from the 1930s and made 2 points, which was that this Great Depression featured a couple of factors, and these are going to be, at the time of this economic downturn, we had an unprecedented banking crisis and also an unprecedented slow recovery. Okay, and here's some data just to show the slow recovery of the economy. In 1929, before the Great Depression happened, the unemployment rate was 3.2%, very normal. We're used to that in Hong Kong. But over the course of the Great Depression, this rose to something almost like 25%. That's the worst outcome that we've ever seen in labor markets in the United States. But if we follow the unemployment through the entire decade, we see that the unemployment rate was almost 15% more than 10 years later. So essentially, this economic downturn was something that lasted for a long time. Lasted far longer than we might think a normal social psychology would lead to a case of pessimism, and longer than the decline of liquidity. So there must have been some other factor there, some factor that led to this economic downturn persistently reducing the ability of the economy to perform. Something must have been destroyed, which caused the economy to underperform for a long time. And what Professor Bernanke said was that thing was the banking system. That is that if you look at the data, something like 40% of U.S. banks failed. And if we keep in mind this idea of Professor Diamond, this is maybe Professor Bernanke was thinking of this simultaneously with Professor Diamond, was that, well, if we do have our banking system destroyed, our banks are storehouses of knowledge. And once that information and relationships that banks have that make the lending as efficient as possible, once that's destroyed, it's gone. And that we can't get our lending back to build our capital expenditure until those relationships grow back. And that long process of developing information is rebuilt. So he said that that this suggests that this long-lasting recession says that following all of the destructions of these banking institutions illustrates the importance of these institutions, not only for economic development, but also for economic stability. He provided a set of evidence about the relationship between banking collapse and collapse in the economy. This chart is based on data from his paper, which basically shows the total amount of deposits of banks that failed in the U.S. during this period between 1929 and 1933, and the interest rate that was charged on loans as a premium over interest rates paid on bank deposits. This lending spread represents the risks that bank loans are going to have. And what we see is that over the wave of this crisis, there was a acceleration in this lending premium, which only basically was alleviated after the bank holiday, which closed a lot of banks. We see in 1933 that the incoming Roosevelt administration closed a lot of banks, had regulators come in and try to separate good banks from bad banks, and then try to proceed from there. Okay, and what he also showed was that businesses that relied on bank lending suffered in terms of their investment in employment when the banks that they were used to borrowing from collapsed, illustrating the importance of those relationships to individual borrowers. Or rather, he showed that industries that rely on bank lending were going to be those parts of the economy that suffered the worst downturn. Okay, so just to summarize the ideas that we see here, which is that we have a bank structure that allows for maximizing the returns of our financial system while minimizing the micro level risks. So we're going to see a strong tendency for our financial system to follow these structures, because since they are efficient structures, they're likely to have a competitive advantage, and they're likely to replace other institutions that don't have these structures. So if we limit our institutions to not have this structure, then they're likely to give rise to parallel institutions like shadow banks, which have the efficient structure. But while this structure is efficient in most cases, it's going to also be a structure that lacks resilience. That is going to finance long-term illiquid assets, primarily with short-term debt. And that's going to be a situation that when there is macro level risk, when there is a macro level downturn, then that's when our structures are likely to fail, and they're going to fail in waves. Okay, and so this is a picture of bank failures in the United States, and what we see is that in most normal times, almost no banks fail because they're efficient structures. But when we do see bank failures, then we're likely to see a lot of them. So this occurred in essentially the late 1980s. A lot of small institutions failed, but we see another wave during the global financial crisis of 2008. Okay, bank failures, they will occur in groups, and they will have the nature of panics, because the structure of banking is based on short-term debt that allows people to get their money back very quickly. There's a good reason for that. This provides liquidity for people, also provides discipline for banks. But when they fail, they'll fail very rapidly as people scramble to get their money back. Also shown by Professor Bernanke, when banks fail, when we have these waves of bank failure, this is likely to have large consequences on the macro stability, taking a bad situation and making it worse for a long time until the economy can restore the lost value of the information that can be destroyed by the destruction of banks. So, in a recollection of his time as a policymaker in 2008, Professor Bernanke said that, well, I and other policymakers oriented our policy during the global financial crisis around making sure that as few banking institutions failed as possible because of the potential consequences for the long-term real stability of employment in the economy. Okay, and so what we see is that because the consequences of bank failures are borne by institutions other than banks, then the cushions that banks are likely to develop to protect themselves from economic downturns are likely to be too small from the standpoint of social welfare. This gives rise to various public policy interventions that can be used to augment banking stability. And there are a variety of policy responses that dominate our institutions today. What they include deposit insurance, promises to make depositors whole. This will discourage them from withdrawing their funds, disincentivizing them from running on a bank, and so heading off these failures to the degree possible. And so this is a characteristic of most of our retail banking, including now in Hong Kong. Hong Kong's deposit insurance in 2008 was underdeveloped, but now we have a more developed deposit insurance here as well. Now, this has some issues. The first is that banks may not have discipline if their depositors are insured. We rely on the depositors to discipline the banks, but also we are likely to see that if we might see shadow banks that are not part of our banking system that will develop parallel systems that are not subject to this deposit insurance. Another possibility, frequently used, definitely used in the global financial crisis of 2008, is to have a lender of last resort in our economy, to have a central institution, usually the central bank, that will step in and guarantee a bank's stability, guarantee a bank's deposits, or all of their liabilities, including potentially our shadow banking institutions, to ensure that even in the worst case scenario, our financial institutions aren't destroyed. Now, if we're going to be providing these benefits to the banking system, we're going to make some additional demands. If we think that the banks are unlikely to have enough macro cushion to insulate the economy, then we may want to legislate that they do so. Okay, so a feature of our banking regulation, a feature of our global banking regulation, is strict requirements that banks have a certain amount of financing that comes from issuing equity, comes from shareholders, rather than from depositors or short-term debt. And that will require them to maintain a sufficient cushion, even if they don't necessarily want to. Okay, now this could give rise to other institutions that don't operate with these restrictions, and so an expansion of our regulations since the global financial crisis is to increase the breadth of these regulations. And another key pillar of banking regulations is requirements that banks keep sufficient amount of liquidity on hand to prevent bank runs. And then a fourth is going to be macroprudential regulations. So here's just some examples. So this is newspaper headlines from 2008. Interventions by the various institutions in Europe and Hong Kong in the United States to essentially act as a lender of last resort to guarantee assets of these money market funds, these shadow banks, a guarantee of the banks in the banking system. So the bank runs at Bank of East Asia ended when the monetary authority intervened and guaranteed the bank's depositors, all of their creditors in every circumstance that they would be made whole. Then the banking panic disappeared overnight. And so this was a key feature. Why they did it was the logic of Professor Bernanke. This is a long, detailed description of the changes in rules that our banking system implemented. Our banking regulators, our global bank regulation is done under the rubric of the Financial Stability Board located in Basel, Switzerland. We call this International Agreement on Basic basic regulations of the banking sector that will occur in all market economies, including Hong Kong and China more broadly. And obviously we could spend weeks talking about these details, years, but the two key elements here is that these are organized around making sure banks have enough capital finance and enough liquidity. And then finally, one economic development, which is to say that since banks' primary risk is to macroeconomic outcomes, then maybe it's true that the regulatory system needs to adjust in light of macroeconomic conditions. So we don't keep our regulations stable over time, but what we do is we adjust them in terms of the systematic risk that are going to be faced by the banking sector. And we call these adjustment of banking regulations over time. These are called macroprudential measures, which is to set our regulatory scheme at any point in time in light of the broader macroeconomic condition of the financial sector. And this has further become used as one more basic tool for stability, to stabilize the economy, because of the importance of the ideas of Professor Bernanke that the situation in the banking sector, the availability of credit, will have macroeconomic effects. This gives one more tool for stabilization policy to help manage the broader macroeconomy. Okay, so basically the ideas here, bank institutions are going to be structured in order to most efficiently provide liquidity and credit to the private sector, given the constraints of the market. So we're likely to see that our financial markets are dominated by institutions with these price structures. That these institutional arrangements are efficient but fragile. In most times they work very well, and these are going to be the dominant market model, but we also face the fact that they enhance macroeconomic risk. And finally, the collapse of the financial intermediaries have long-term consequences for economic stability. Banks have private incentives that deviate from our social goals, giving rise to a role for public policy in stabilizing the banking sector that the private agents might not internalize. Okay, so that's all I have. Thank you, and hopefully we'll see you next year.